Harry. Welcome back to the Insider Playbook. How are you?
Good, thanks, Louisa. Good to be back.
Oh, great. I wanted to have a chat to you today about fixed rates and how they can help the self-employed in the trades industry. Can you give me a bit of an idea of how a fixed rate would help someone, a self-employed person?
Sure, Louisa. If you believe that interest rates are going to rise, you may want to consider fixing all or part of your loan in anticipation of the interest rate rises. So if cash flow is an issue, fixing all or part of your mortgage means that you've got the security and peace of mind of knowing how much you'll be paying for that loan for whatever the fixed rate period may be.
Okay, and are we hearing about rates going up this year?
I believe so. I think it used to be early last year, interest rates were meant to go down, and late last year in 2025, there were rumblings about interest rates going back up because inflation is not as under control as what the Reserve Bank thought it was.
And what are some of the chances that you would take when you do a fixed rate loan?
Well, I suppose the risk of doing a fixed rate loan is that you're taking a punt that interest rates are going up, so you're fixing the rate at today's price. If you're wrong and interest rates go down, you're still fixed at a higher rate. So that's the biggest risk. But that risk can be mitigated if you want to fix not all of your loan, but just part of your loan.
Okay, so you're able to fix half and half or a portion?
Whatever the percentage is.
Yeah.
You may want to fix 25%, you may want to fix 75% or half and half and leave the remaining portion on a variable rate.
Okay. And how do you see if a self-employed person does fix their loan, how does that help them with their business?
So by fixing all or part of your loan, it gives you peace of mind of knowing how much money you spend each month on repaying debts, because you know how much it costs to run your business, hopefully.
Yeah.
And hopefully you know how much your debts and your loan obligations are each month. Now, if the Reserve Bank significantly changes how much you have to pay out to have your loan, then that has implications on your household, personal and business debt as well.
Yeah, so I think that's something that we saw back in 2003 and 2004 when a lot of people were coming off really low fixed rates and they were going up to what the standard variable rates were. And there was a big change back then, and a lot of people had to figure out what they were going to do. Now, with fixed rates, there are things that you do need to be aware of. Can you tell me some of those things that people might not be aware of?
Sure. Well, besides the fact that you may be fixing it at a higher rate if interest rates go down, usually with fixed rate loans, you can't pay them off quicker. So if the fixed rate period's for 3 years or 5 years, that's how long it's fixed for.
Okay.
It often doesn't have an offset function or a redraw function, which means that you can't lower your repayments. Fixed rate loans also, if for whatever reason your circumstances change and you want to sell the property that the loan is on, you'll probably have to pay out a payout fee to break the fixed rate term.
Okay, and I would say that would be different to each bank with what the payout figure or what the penalty would be. It's different with each bank.
It is, and it depends on your loan and depends on a lot of things.
Yeah. Okay, so fixed rates are great if you need to be aware of what your cash flow is and how much money you're paying out. If you are concerned about the RBA, the rates are going up. So what you would suggest is that they come and speak to Chocolate Money to get the advice on whether they should fix or not, and they'd be able to help them. Is that correct?
Yes.
Yep. Fantastic. Thank you, Harry. We'll see you next time.
Will do.
Thanks.
Thank you.